The Russian invasion of Ukraine continues to bring a lot of volatility to the stock market. What are the risks? What are the opportunities? How can you do better with your money? Well, that's some of the things that I'm going to address today as I walk through an analysis of the market showing how everything connects. Are we going to crash or are we going to rally? Plus, there's a little trick that you can use to make money off of rising gasoline prices. I'll show you what that is, and a controversy around a particular group of exchange traded funds related to Russia. Finally, there's a very simple market scan that you can run to find stocks that do well even when the market is going down. That's all coming up in this week's Market Minutes. All right, so we had another down week for the market. What does that mean for your money? Well, let's walk through some charts and I'll try to show you not only where the market is likely to go, but what to watch for as a cue that the market is going to change direction. So the first chart that I have up today is a chart of the S&P 500. This is a 3-year weekly chart. And we've talked about this in recent weeks, but you can see that the upward trend line has been broken and we've been basically headed lower for the last 2 months. You can see that the Stockscores, which had been high through the period that the market was rising, have now fallen. That's the way they're supposed to go. And so in this time frame, when we think about the longer term direction of the overall stock market, we have a bearish situation. So generally speaking, you want to be cautious. When we look for turning points, what I like to do is look at a shorter term chart. So I'm going to bring up the same thing, the S&P 500 ETF, symbol is SPY, and this is the 30-day 60-minute chart. You can see that the the tops are still falling, but we also have a situation where the bottoms are starting to rise. So this is called a pennant pattern. Now this is when the situation with Russia and the Ukraine really dominated the market and you saw a pretty sharp sell-off. Since that time, we've had a bounce back and then a move lower. And what we're getting is this market pattern where price volatility is compressing. So over here, there's a lot of volatility, and now we're getting less and less. We're still in that downward trend, but the volatility is compressing. Now, what does that mean? When you have compressing volatility, it means that the buyers and sellers are starting to agree about what something is worth. And so we had the market move down on the negative news around Russia and Ukraine, and the market is slowly deciding, okay, that's worth this much. It's worth this much of a drop. And as you compress in that volatility, what you then look for is the next set of information, the next important bit of information to come into the market. And when it does, you will break out of that pattern. So if we go back to this pattern of the S&P on the short term, if we break down through the bottom of that pattern, it means more negative news. If we break up through the top of that pattern, breaking that downward trend line, then it means the market is seeing something positive. Now, neither has happened yet. What's most likely to happen is the market is going to move down because typically the trend into the pennant is the trend out of the pennant. If instead we are able to break upward through that downward trend line, then we are maybe going to see some buying come back, some bargain hunting. So for now, still a bearish chart in the short term. Now let's take a look at the Nasdaq 100. Symbol for that is QQQ. And again, on the daily chart here, we have a downward trend, which means we want to generally be avoiding buying these stocks. I know it feels like there's bargains to be had, but in terms of bargain hunting, you want to wait until you can at least break the downward trend line. Typically, breaks of downward trend lines come after the formation of a rising bottom. So you have a new low here, and on the daily chart, we made a little bit slightly rising bottom there. If we could then break the downward trend line, that might be a time to start looking for bargains in the tech space. You know, some of these large cap tech stocks have really sold off quite sharply. Is there an opportunity to buy them right now? I would say no, but it could happen any day if we can break that downward trend line. Now the small caps, which is a symbol IWM in the US, doesn't have quite the negative chart that the large cap stocks have. One of the reasons is that the small caps never had a strong upward trend. They've been going sideways for most of 2021, while the large cap stocks were heading higher. And so what that means is that the small caps didn't have as far to fall, and they have fallen, but they have been actually quite stable in recent weeks. And I actually think that the better opportunity going forward will be in some of these small cap markets, because many of those stocks have fallen a lot and they have a lot more to gain. They're really so oversold that they're probably not going to move a lot lower. Does that mean buy them tomorrow? No, we got to wait for the chart to tell us when to buy. So let's go back to this daily chart. You can see we still have the falling tops. We've got a double bottom, which means that the buyers have defended that price level. And again, what we need is to break that downward trend line, which goes back to November of last year. If we can break that downward trend line from these little rising bottoms, then I think you start looking at biotech, at some of the junior technology companies, the smaller companies. These are stocks that have really been decimated in the last really year, and they maybe present some opportunity. They were super hot when we had the recovery from the COVID crash, and now they're really ignored, probably oversold, due for a bounce back. Just got to wait for that to happen. All right, let's go now to the Canadian market, and the symbol here is T.XIU for the TSX, and you see a very different chart than you see in the US markets. Now you see lots of volatility. Now that means that there's lots of uncertainty. Notice the volatility now compared to how the market normally trades is considerably different. So the fact that there's lots of volatility means that the market is difficult to predict, and it means that buyers and sellers really don't agree about what the market is worth. That's why it's swinging so wildly. Now, I would say that the TSX is sort of two different markets. You have the markets that do well because rising commodity prices are in place, and then you have the rest of the market. So obviously oil, which has a heavy denomination in the Canadian market, has been moving higher, and that's propping up the TSX. Also the mining sectors, and even some of the banks, which have been doing well because there's this expectation for rising interest rates. And so you have those sectors of the markets sort of stabilizing and keeping the TSX up, while other sectors of the TSX have really been doing poorly. And so this is where you have to sort of play the sector of the market as opposed to playing the market in general. So I would say in general, I don't want to be a buyer of TSX stocks, but there are opportunities perhaps in some of those commodity related sectors. Now let's jump to the 3-year weekly just to get the big picture view here. There's the long-term upward trend. It was broken here, and we've simply gone into a sideways trading range. If we break down out of the range, then you got to be really defensive with those longer-term holdings that you may have for Canada. If we break up, then the general direction of the TSX is higher. But again, it could be that certain sectors lead the way up or down, and not necessarily that the whole market does, because the TSX has such a heavy concentration of commodity related stocks. If you want to make money in the commodity sectors, the TSX is a great place to look because there are so many of them there. Now let's take a look at the junior markets in Canada. For that, the symbol is $JX, which represents the TSX Venture Composite Index. And this is just an index, it's not an exchange traded fund. But you can see that we have consistently falling tops. That means the sellers are in control. But notice that the slope is getting flatter. That means that the sellers are not as eager anymore. And so if we can break the downward trend line with some strength to the upside, building some rising bottoms, you may see some money come back to those micro-cap stocks in Canada. They've been largely ignored of late. I think retail traders, which tend to trade this market, are not too excited and therefore not so eager to be buying these stocks just yet. All right, so let's now jump away from the stock market and go into the US dollar chart. For that, UUP is the chart. Let's take a look at UUP. Then we're going to start to tie some of these things together, how they all interrelate. So here's the chart of the US dollar. I like to look at a 3-year weekly, so let's click on 3Y to bring up a 3-year chart of the US dollar. And again, this is the US dollar ETF. All right, so you can see the US dollar really underperformed through 2020 into 2021, broke the downward trend line, made a double bottom, and then broke up from that rising bottom back then in the fall of 2021. And that's the point that I became bullish on the US dollar. Well, now you've got, as a flight to quality perhaps with controversy in the world, money comes into the US dollar as a safe haven. The US is a safer place to be than other areas. Obviously, many areas in Europe would not be so well insulated from what's going on in the Russia-Ukraine conflict. So the US dollar is strong. What's interesting though, and by the way, I think it's more likely to go higher than lower, but what's interesting is how this affects commodity prices. We'll come to that in just a moment, but first, let's take a look at crypto, and we'll look at the chart of one of the crypto ETFs. This is based on Bitcoin, and we've talked about Bitcoin maybe trying to make a bottom here because it is at long-term support. It tried to break that little downward trend line. It's been kind of feeble so far, and it's compressing in its volatility towards support. If Bitcoin breaks down through that floor price, I think it's headed to this level. So although it's trying to bottom, it needs to now break upward off of this floor again for me to get enthusiastic about it. Notice the stock scores are quite low. That's because we have the sellers in control of Bitcoin and really most of the cryptocurrencies. If it breaks down through this floor, I think it's headed lower down to that level. If it can bounce off of the floor and break the downward trend line, then we may start to see a recovery in Bitcoin. All right, so now let's jump over to some of those commodity ETFs. Now, typically, when the US dollar is rising, it will help those commodity-based sectors go lower because they're all priced in US dollars. So, we buy oil in US dollars typically, or it's priced in US dollars. If the cost of the US dollar for other countries in the world is higher, then you would expect that the price of oil would go down, but that's not what's happening. So we've got sort of a backward world here where commodity prices are going up and the US dollar is going up. And that's a unique situation related to that conflict in Europe between Russia and the Ukraine. So here's the chart of oil. And you can see it's gone parabolic. So if I was to draw a line across the bottoms, that's a linear trend line. Notice that oil prices ran up and away. That typically comes near the top. When parabolic trends happen, and then the parabolic trend is broken, it usually means prices are going to pull back. And that's what we had in oil this week. Now, we haven't broken the linear upward trend yet, so it doesn't mean that it's over for oil. But I do think that oil prices went up too fast, they're pulling back, and they'll probably come back to this linear upward trend line. What that means in the short term is if you're a trader of energy stocks, and we'll talk about gold in a moment, you want to be pretty defensive right now because those things moved up a little too fast and they're now pulling back in some profit taking. I think there may be an opportunity to be a buyer if we get back to that trend line. And if we can break this pullback, yes. But right now, be very cautious, defensive with those commodity sectors. Let's take a look at gold. And just to sort of drive home this point, gold also has been moving up in the last 6 weeks or so as it broke out. As it broke out of this trading range. Oh, my line tool is not going to work anymore. As it broke out of this trading range, we broke out, we moved higher. Let's take a look at that 3-year weekly chart. And what's happened now is oil has come back to these highs right here. And in coming back to those highs, it meets a natural wall of sellers. And so it's likely that gold is going to stall here for a little bit. Looking out weeks or months, it could still be higher. But in the short term, I think you want to play a little bit of defense because they went up quickly and now they're getting a little bit tired. All right, now I promised you that I would show you a way to make money from rising gasoline prices. This is one that you just want to put in your toolkit for the future because I think it's a little late now, but perhaps in a few weeks we can consider this again. But there is an ETF that tracks gasoline prices. Its symbol is UGA. And you can see that the chart of UGA has gone absolutely parabolic and it's now pulling back to that linear trend line. So I can draw a line across these bottoms and you can see that we're basically coming back to that linear trend line. So imagine you own a business, you've got 10 trucks on the road. You want to hedge against rising gasoline prices. You're seeing the price of the pump go up. One of the things you can do is buy an ETF like this. You'll make money on the ETF because it goes up in price, and that's going to compensate you for the higher cost of putting fuel in your vehicles. And so you just think, okay, normally I spend $500 a month on gasoline. Now I got to spend $800 a month. How many shares of this ETF would you have had to buy to compensate for that rising cost per month? And you could just say, well, if I had bought, 100 shares of this ETF at $48, now it's at $58, I would have made $1,000, and that would compensate me for 3 months of my higher gasoline prices. A little trick that it's called hedging, and in this case, hedging against higher gasoline prices. There's many ways to do that. Now, I want to show you one other ETF that has a lot of controversy. And there's actually 3 or 4, and these are all ETFs that are related to Russia. Now, of course, Russia has been sort of blocked out from the rest of the world. Well, there's an ETF, RSX, that has gone down precipitously with the attack on Ukraine. You can see it's gone down. It's actually stopped trading because this ETF now has what's called a net asset value of nearly zero. I think it's around 90 cents or something, maybe even be lower now. So as these companies have been forbidden to do business in the West, these Russian companies, how they can't get their currency out, all these different issues has meant that this ETF has really fallen. So it has stopped trading, and there's others that have, ERUS, another one that has stopped trading. Well, the controversy comes for people that bought put options on these ETFs. Now, a put option is how you make money from something going lower. Well, they halted trading in this, and that meant that the put options can't be exited. So someone that bought the put that may have a huge profit from betting that the Russian market was going to crash, now they can't liquidate their option. The options expire. They get a zero when really they should have made a whole bunch of money. So it's a bit of controversy. And if you go on the internet, you'll hear a lot of people complaining about this because they had these massive profits in this trade and they can't even take the money out. The put options expire because they have an expiry date. They're going to expire with a value of zero because they don't trade. Be interesting to see how that plays out. All right, the last thing I want to talk about today is a way to make money in this down market. So obviously we've got a lot of volatility. How do you do it? The key is to trade alpha stocks. So alpha stocks are those that are trading on their own story, that have some excitement. They're characterized by very abnormal volume. So if these stocks that trade very abnormal volume, you watch them for entry points. One of the things that we've been doing on my active live service on Stockscores is building a list each day of the stocks that are abnormal and then waiting for them to come alive again. There tends to be this pattern. The stock will be really abnormal, trade huge volume, make big gains, and then the following day it gets really quiet. And it may get really quiet for a few days and then it comes alive again. So what we want to do is play what I call the abnormal echo. We build a list of the stocks that are abnormal and then we monitor them for the days ahead and look for when they start to come alive again. Let me show you an example that emphasizes this. So one of the hot stocks last week was HYMC. It's a gold and silver miner, and obviously gold and silver, a hot area. This stock came alive 4 days ago. All right, so that was the abnormal day. And then we're going to look for the echo. I'm going to show you what happened intraday going back 10 days. So there you can see on the 8th of March, it came alive with abnormal activity. We're not going to worry about it that day, but all that that day does is puts it on our list to watch for the future. Okay? The following day is very quiet. The third day, it starts to come alive again. And you can see right here, it's breaking up from a little rising bottom at about 95 cents. And that was on Thursday. By Friday, it hit $2.40. That's more than a double. It's like 250% return on something that I have to tell you I know nothing about. I learned this weekend that they're a gold and silver miner, but all I'm doing is following market action, building a list of abnormal stocks, really abnormal stocks, and then watching them in the days after they start being abnormal for the echo, for that next move. So how do you find the abnormal stocks? Well, in Stockscores, we have this market scan tool. We're going to go in there now, and I'm going to just do a very simple scan. I want to find all the stocks that are trading at least up 3%, so they're making a good gain, but not a considerable gain, but are trading abnormal volume, okay? And we want quite liquid. So let's set a liquidity of at least 10,000 trades a day. I call this my abnormal echo. I'm then going to run the market scan, And I've got 21 stocks that on Friday were trading very abnormal volume and made a gain of at least 3% and had good liquidity, 10,000 trades a day or more, maybe 50,000 trades a day. I can then go through the charts of these stocks looking for stocks that surprised us with abnormal volume. So let me cycle down. There's a couple here that stood out. I did this scan earlier. Here's one right here, SLDB. It traded 12,000 times on Friday. The volume is very abnormal, and the price action made an abnormal gain. Okay, regardless of whether you traded this stock on Friday, all you do now is you put it on a list. Take out a Post-it note, take out a pen, write down SLDB. That's a stock I'm going to watch for the next 4 or 5 days. Maybe, well, most likely on Monday, it'll quiet down. Maybe Tuesday, it starts to come alive again. When it starts to come alive, that's the echo, and that's how you're going to profit as that stock comes alive on the second wave. Some of them never come alive again. We just keep watching. I would say 20%, 30% come alive again later. So you got to wait. But the thing is that echo is when you can go back to that hot stock and trade it for the next wave higher. Well, hey, I hope you've enjoyed this. If so, leave a comment what you like most about this week's video. I've changed the format up. I will be doing a second educational video each week, and that's going to come in a couple of days after this one. So we're going to do more market analysis in one video, and then I'm going to teach how to trade, how to invest in the stock market in a second video each week. Let me know what your thoughts are about that. If you enjoyed this, hit the like button, subscribe to the channel, and most importantly, trade well.